As we close out a week that has, of course, seen a continued focus on the breakdown of relations between the US and China. What has the new week got in store for us? Well, PMIs will be a center point in a week that by and large dials down the data, but nonetheless is likely to see significant volatility. So let's get into the week ahead for the week starting Monday, the 21st of April. So we've got a shortened version this time around, and mainly because it's just a relatively quiet week, really, in terms of economic data, and we can see that here. So in the UK, we've got a bank holiday on Monday, long weekend for Easter, and so certainly I think Monday is going to be relatively quiet. Wednesday is where most of the action takes place, and that's because we've got the release of PMI numbers pretty much across the board. Highlighted here are Europe, and the US, but we also see Australia, Japan, Canada, and the like. Then Thursday, IFO Business Climate Survey out of Germany, the durable goods orders numbers, and the existing home sales out of the US, and the retail sales from the UK. So let's start off with Europe. Europe, certainly an interesting one at the moment. It comes off the back of the ECB meeting, and it also comes off the back of the fact that ongoing discussions between the EU and the US have failed to reach any breakthrough, and there's an expectation that the tariffs will remain in play. Of course, those reciprocal tariffs, apart from China, have been delayed by 90 days, so that has provided somewhat of a reprieve. But the question mark here is, do we start to see a negative impact coming through to the data? And when we're looking at the April data here, this highlights why the PMIs are so important, because they're a leading indicator. They're a relatively early indicator of exactly what the status quo is right now in terms of the economy, and quite the opposite from something like a GDP figure, which generally will be very lagging. You have to wait months to see what happened in the previous quarter. So this is relatively up to date, and that's why it's going to be particularly interesting. And now, ultimately, because of the fact that the EU is in the same position as the UK in the sense of its 10% tariffs, it's the same kind of picture. What are we seeing in terms of implications for economies that are major exporters to the US? How are we seeing that impact, in particular the manufacturing survey? So look out for those manufacturing PMIs, and it should give you a good idea of exactly how these businesses are faring. There will be a significant amount of sort of front running when it comes to these tariffs for businesses. So there's a possibility that the strength seen last time around could be reversed once the tariffs have been implemented and people essentially front load those purchases and then drop off quite significantly after. So that's something that we're going to be looking out for. And then UK retail sales, IFO business climate, that'll be interesting. But nonetheless, I think the PMIs are really going to be the big ticket item. You can see here, this is not the DAX price to earnings ratio. I should have changed the title on this, but this is the PMI figures of late. You can see that Eurozone numbers doing relatively well, actually. The Eurozone PMI numbers on the manufacturing side have been on the rise quite sharply alongside the German figure. That's probably driving it to a large extent. The UK going in quite the opposite direction. In terms of the composite readings, both of them in expansion territory, which is a positive. But this is that DAX to price to earnings ratio chart that we've been looking at recently, and showing that the decline that we've been seeing does at least take it out of somewhat expensive terms and provides the basis for people to potentially think, maybe we see some value if we see a potential breakthrough. And at the moment, we're not necessarily seeing a breakthrough. Instead, we're seeing the possibility of a period of just 10%, plus the autos, plus potentially whatever Trump puts on, let's say pharma. But nonetheless, not the 20. So that's something at least. But what we're looking at here in terms of the DAX is that we've seen this sort of initial collapse in the DAX, the rebound, the subsequent rebound in the second half of the month, certainly after the initial fears surrounding the breakdown of trade. And here's the chart. So so we've got the initial breakdown when we saw the tariffs implemented, and then we've seen that sort of recovery, that gradual recovery taking hold. Now, of course, markets like to go up generally, right? That is the direction of travel, but we need to see further signs that we could see a breakthrough. The underlying sort of factors within the Eurozone around higher spending on defense, on infrastructure. That alongside a potential trade deal with the US, great. But the risk of a global recession, not great. The risk of a potential additional breakdown in terms of the trade relationship with them and the US, not great. So there's likely to be continued jitters, I think, going forward. And, we've sort of recovered quite a significant amount. If we were to look at this on a sort of retracement perspective, say, okay, we've come almost into the 61.8. So, a gradual grinding higher, but that's where this PMI survey comes in. If we start to see things roll over in terms of the PMIs, then that could be a warning sign of what could be to come if we don't see a trade deal come to fruition. In a way, that might actually be helping. It might actually help Donald Trump's cause to let things play out a little bit in terms of the data, let things worsen, in particular abroad, and then you have the basis for people to come to the table. Perhaps that's how it's played out. Not sure. I mean, ultimately, if the US data also weakens, then it's not going to be great for a great look for him either, and it's potentially going to pass some pressure on him. So we've got this sort of trend line support coming into play at the moment. A breakthrough 209.54 would provide that renewed sort of bearish move lower for the DAX. But until then, we're continuing to grind higher for this key market. Then let's look at the US. Now, the US, of course, is always going to be absolutely key because, quite frankly, we don't really need anything on the economic calendar to be able to see big volatility in the US markets at the moment. All we need is Donald Trump to come out and say something new. And he's done it recently with the fact that he's banning some of these chips that are being exported to China, NVIDIA leading the declines alongside ARM, Intel saying that they might be in the same boat. So the tech sector really coming under pressure of late. So what are we seeing this week? Well, we have got a few key figures to look out for. We've got the PMI numbers on Wednesday. We've got durable goods data on Thursday. That is March, not April. It's worth bearing in mind. Existing home sales and that Michigan consumer sentiment survey, the final figure, but that is very notable. If you look at that figure, right, that the decline that we've seen as an expectation, it comes down to 50.8 from 57. So the sentiment surveys really are the sort of first ones to move, because it's telling you about how people feel rather than what they're actually doing. It's down the line that you then start to see figures like PMIs or retail sales that tell you exactly what they're doing. And then down the line, you'll see additional data like GDP to see how that's impacting the entire economy. But yeah, so for this week, we're going to be looking out for the potential decline in terms of manufacturing. As you can see here, 50.2 down to 49.5. So that, alongside a weakening of the services picture, which is expected here, points towards a sharp decline in terms of the composite reading, 53.5 down to 51. So markets are expecting that the US economy starts to show signs of weakness. And this is the first major sign that that's what's happening. Now, bear in mind, we've just heard from Jay Powell out in Chicago, and he's essentially said, we're patient because ultimately we have a dual mandate. And on one side, we need to make sure that we don't see a spike in terms of unemployment, on the other, and weakening growth. On the other side, we have the need to keep prices under control. And with the tariffs being worse than we expected, there's the possibility we could see that providing a detrimental effect to the economy, but also there's a possibility that it's highly inflationary. He also said that the US economy is currently very strong, and that certainly didn't help market sentiment at all. So the question mark is, how does this data feed into those narratives, right? Does it point towards inflation coming? Well, we'll look in terms of the sort of breakdown of the data in terms of whether it says that, we're seeing a spike in terms of inflation because of tariffs. Might be a bit early, but look out for that. Also look out for some of the other underlying metrics that might signal a potential worsening of the economy. And all of that will feed into the expectations for the Federal Reserve. And so we can see here in terms of, these are the interest rate probability for the December 2025 meeting. I thought that was an interesting one to add on because it sort of wraps up, rather than just this coming meeting, I think it sort of gives you a good idea of exactly what's expected for the year in terms of easing, and overlaid it against the US dollar. What's notable here is that we've actually seen a bit of a spike. If you remember that chart that I showed you with the DAX, it looks very similar, right? We saw that initial pullback, and then we saw a bit of a rebound recently, a bit of a recovery, as essentially Donald Trump rolled back those reciprocal tariffs, apart from China, and that sort of eased some of the concerns because, There's only so much you can do without breaking the economy, quite frankly. And nonetheless, the US dollar has just continued on that downward pathway. And that highlights the fact that, yes, to an extent, it is being driven by interest rate probabilities, and relative interest rate probabilities. But it's also reflecting a loss of confidence in the US economy, a loss of confidence in the US as a place to do business or invest, and people potentially looking elsewhere. And that's possibly why we're seeing the US dollar continue to weaken despite that rise that we're seeing in terms of the expectations for where rates are going to go going forward. But like I said, the data for this coming week could be key in driving those expectations. Let's get back to the charts and we can see that essentially, here we go. So this is the dollar index, and this is an absolutely great market to be trading at the moment. It just keeps going down essentially, and that's exactly what you want, right? You want a market that just does the same thing over and over again, which is ideal. Like we've said here, there's the interest rate expectations have sort of risen a little bit, but we've seen the US dollar continue to move lower. If we see this report coming out and it's, these PMI numbers are relatively strong, we see signals of potential inflation coming because of tariffs, then we could possibly see a move towards the upside for this market, for the US dollar. But I would say, probably makes sense to just follow the trend, right? I mean, it's very clearly defined. And if we're looking out here in terms of sort of swing highs more recently, we're looking at this sort of continued sort of retracement and then sell off, retracement and then sell off, retracement. Well, and then sell off, and then we're tracing here, and then we sold off once again. So if we break back up through this 100.276, then it looks like we could come into a wider retracement. Until that happens, looks like we're probably going to roll over once again. The caveat here, of course, is that wider outlook. You can see here that we've got this big support level around the sort of 99.5 support mark, and below that we're hitting the lowest level since early 2022. We are kind of through that as it is, but I would say, I have seen plenty of times where we've sort of run through a level and then sort of near enough respected it and reversed once again. But certainly the expectations of where the Federal Reserve are going to go over the course of this year will be key, with the dual mandate coming into play, and the PMI numbers providing a key insight into exactly what the US economy is doing in the month of April after the imposition of those 10% tariffs and the auto tariffs in particular, and everything that's happening in China. Keep an eye out for the US dollar, as it's probably one of the best markets to be trading at the moment, very consistent in nature. Let's see if the data doubles down on that consistency or serves to reverse it into the opposite direction. Thanks a lot for watching. My name is Josh Mahony, Chief Market Analyst at Scope Markets. Have a great weekend and a great week ahead. Thank you.